Other than deciding where to invest or what opportunities to not invest into, corporate finance also looks at where to find the money to make these investments. Remember back in our financial accounting groups, there was kind of two different ways you can find money. One can be through debt or liabilities. The other one is through equity or investors. Remember, debt you have to repay, and equity is kind of like giving a part of the company away for an investment into the company or an investment later on. So this ratio of debt to equity is what we call leverage when we're looking at financial accounting. Now, this leverage is going to be very important as we go forward. You see, using too much debt can be risky because you won't be able to actually pay off your interest rates, and eventually that might lead you to bankruptcy. Using too much equity means that you're not growing as fast as you could because you could leverage up and use more debt and grow faster. So you might lose the competition who is using debt and they're buying things. Our example in that case was buying a home with cash, which is extremely expensive, and if we all had to do it, be nearly impossible. That's why we all have mortgages, so that we can actually buy homes and live in them. But of course, as we learned with some other companies like Toys R Us, if you have too much debt, you won't be able to invest in anything else because your interest payments on that debt take up so much of your profits. So balancing this debt and equity relationship is really tough, but that's what corporate finance people do. And we're actually going to show you how they make those decisions with something called weighted average cost of capital, also known as WACC. WACC. Now, saying weighted average cost of capital is kind of hard, tedious, and not that much fun. Saying WACC is way more fun. So from now on out, if you hear me say WACC, you know that's what I'm talking about. And we're going to get into that right now.